Oil flirting with triple digits, yields grinding higher, and an AI-driven equity complex finally blinking are tightening cross-asset linkages again. Welcome to vTalkInsight, Allocator's Lens Daily for June 9th, 2026. Today's backdrop forces allocators to weigh strong earnings and ample liquidity against rising inflation risks, geopolitical shocks, and heavy primary market supply. Let's begin with equities, where the tug-of-war between secular growth and valuation risk is front and center. In equities, the central tension is between powerful earnings and AI-driven growth on one side, and higher rates, rising oil, and a looming supply wave on the other. Price action has shifted from a one-way melt up towards sharper swings, as that conflict is now being expressed through volatility rather than straight-line gains. Nowhere is this clearer than in technology and semiconductors. Chip indices had reached extreme technical levels, in some cases more than 70% above long-term trend, before suffering their worst single-day decline since 2020 and dragging the Nasdaq and Asian benchmarks sharply lower. Valuations have re-rated from forward multiples in the high teens to the high 20s, and even after the sell-off, several semiconductor indices are described as having room to fall before they look technically oversold. Yet the fundamental AI story remains robust. Semiconductor sector earnings have surged by more than 50% since January, with some measures of technology earnings ex-megacaps up around 50% year-on-year, the fastest pace since the financial crisis. Infrastructure demand is intense, with hyperscalers struggling to secure enough compute, disciplined supply at the leading edge, and headline deals such as Google reportedly ordering millions of specialized AI chips from Intel and NVIDIA partnering with SK Hynix on next-generation memory. Against that backdrop, equity supply is ramping up. Equity capital markets activity is up well over half-quarter to date. Large tech firms are raising capital to fund increasingly asset-intensive AI spending, and mega deals such as the anticipated SpaceX listing could attract tens of billions of retail demand. Leveraged exchange-traded fund assets tied to U.S. equities and semiconductors sit near record highs, so reallocations to high-profile offerings could force selling in recent winners and amplify volatility, especially given history that large IPOs often experience sizable drawdowns after their initial surge. At the index level, leadership is broadening even as tech wobbles. Small caps, such as the Russell 2000, are outperforming the S&P 500. Equal weight indices are keeping pace with cap-weighted benchmarks, and emerging market equities in Brazil, Mexico, and Poland have outpaced the United States year-to-date. In Europe, equities open lower, led by technology and weighed down by Middle East tensions, even as energy stocks rose with Brent near $97 and Italian banks rallied on consolidation, moves around Monte dei Paschi. Overlaying all of this is a clear uptick in volatility. The S&P 500 fell nearly 3% on Friday, before clawing back a fraction on Monday, and the volatility index has risen from the mid-teens toward the high teens and low 20s. Markets swung intraday as reports suggested Iranian operations against Israel had paused, illustrating how quickly geopolitical headlines can flip risk appetite. For now, the equity story is one of strong fundamentals colliding with higher discount rates, oil shock risk, and heavy new issuance, leaving allocators focused on how much more volatility is needed to reset extended positioning, particularly in AI-linked names. In rates, the message is that higher for longer is being repriced more aggressively. A strong U.S. jobs report has pushed Treasury yields to new highs for the year, with the 2-year around 4.17% and the 10-year above 4.5%, and some desks openly discussing the risk of 10-year yields approaching 5%. The 2-year now trades roughly 40 to 50 basis points above the policy rate in short-term cash, signaling that markets see more rate risk than current Federal Reserve guidance. Market-based probabilities for a Fed hike by year-end have jumped, with one widely watched measure moving from the mid-40s to about 70% after payrolls. Globally, central banks are shifting toward more restrictive stances, with investors penciling in additional hikes from the European Central Bank and the Bank of England. At the same time, several commentators still see an extended pause as the base case, noting that the bar for further Fed hikes is high and that elevated real yields have yet to meaningfully slow consumption or business activity. Long-end dynamics add another layer. Term premium on long-dated treasuries has risen from pandemic-era lows, but remains below historical norms, suggesting that the prior regime of very low inflation and aggressive balance sheet expansion is over, yet the full compensation for duration risk may not have returned. In Europe, there's growing concern that the ECB could over-tighten into already softening growth, raising the risk of a hawkish policy mistake even as inflation remains above target. For multi-asset portfolios, this mix points to a focus on the curve and incoming data. Some see scope for curve steepening as inflation uncertainty and term premium push long yields relatively higher, while others highlight the potential for duration to act as a hedge if growth disappoints after the summer. Near term, hotter than expected consumer or producer price releases, combined with any further spike in oil, could lift yields again and further erode the prospect of rate cuts, reinforcing the pressure on equity valuations and more leveraged parts of the credit complex. Credit markets still look resilient on the surface. Investment-grade and high-yield spreads are hovering near historic lows, consistent with confidence in economic resilience and the soft landing narrative, even as yields in absolute terms remain attractive for those willing to take moderate credit risk. In securitized markets, European collateralized loan obligations are offering around 20 basis points more spread than U.S. peers, with improving collateral metrics and supportive technicals cited as relative value arguments. Beneath the surface, private markets are showing more strain. Semi-liquid private equity vehicles have seen rising redemptions, with one flagship strategy reporting outflows near 10%, largely driven by a small number of large investors rather than broad retail panic. Private credit funds are also grappling with concerns over loan quality and tightened redemption terms, especially in retail-oriented products. Even though some large platforms have delivered positive returns in most recent months, and say current outflows are covered by repayments and new inflows. Private equity exits in software have slowed sharply, with deal volumes down about 70% year-on-year and valuations marked lower, underscoring how higher rates and changing growth expectations are biting in the most duration-sensitive assets. In corporate credit, airlines highlight sector-specific vulnerability, as jet fuel costs have industry profit forecasts and raise the risk of weaker carriers facing distress or consolidation. Against that backdrop, the International Monetary Fund's warning that markets remain underprepared for persistent and accumulating shocks sits uncomfortably alongside still tight public spreads. Foreign exchange is telling a slightly different story from rates and commodities. Despite higher U.S. yields and escalating Middle East tensions, the dollar has been described as surprisingly flat, with limited evidence of the classic haven surge. One factor is concern around potential intervention as dollar-yen trades above 160, while another is that several other central banks are also leaning hawkish, narrowing policy differentials. Looking beyond the near term, some see the U.S. currency as overvalued, with rising fiscal deficits and a gradual increase in non-dollar oil transactions cited as structural headwinds. If those forces build, and if AI-driven growth and reform momentum in select emerging markets persist, the case for a more diversified currency mix could strengthen over the next cycle. So far this year, emerging market risk assets have been resilient, with equities in countries such as Brazil, Mexico, and Poland outperforming the S&P 500 and a broad EM basket seen as capable of rotating from AI-heavy North Asia toward commodity exporters if geopolitical or tech-specific risks escalate. Crypto assets have lagged despite the AI theme, but ongoing tokenization efforts and rising AI-related security needs are viewed as reinforcing the longer-term blockchain narrative, even if price action is currently subdued. Commodities, and oil in particular, are again central to the macro debate. Geopolitical tensions between Iran and Israel have escalated from rhetoric to direct action, with associated involvement of Hezbollah and Houthi threats to Red Sea shipping, pushing Brent toward $97 and triggering intraday spikes close to $98. Prices then retreated into the mid-90s after reports that Iranian operations had paused and ceasefire discussions were in play. But inventories are low, and there is growing concern that current export flows are unsustainable, leaving the market exposed to a sudden supply shock. The macro implications are significant. Persistent high oil prices are expected by some to keep U.S. inflation near 4% into year-end, reducing the likelihood of imminent Federal Reserve cuts and potentially forcing further tightening if upcoming data surprise to the upside. More extreme scenarios envision crude jumping toward $125 to $150 if regional conflict escalates, an outcome that would represent a clear downside shock for risk assets and could revive stagflation concerns. Real economy stress is already visible in energy-sensitive sectors. Airline industry profit forecasts have been cut roughly in half, from over $40 billion to just above $20 billion, as surging jet fuel costs bite into margins. Executives warn that further fuel spikes would require higher ticket prices, risking weaker demand after the summer season and increasing the likelihood of financial strain or bankruptcy for more leveraged, price-sensitive carriers, even as stronger airlines position for consolidation and seek additional aircraft capacity. Elsewhere in commodities, traditional hedges are under pressure. Gold is losing ground to strong equity earnings and higher long-dated yields, reducing its appeal as a safe haven, while industrial metals, such as copper, are closely tracking equity performance and face downside risk if stocks weaken further and deflationary signals from China persist. With stock bond diversification having faltered in recent sell-offs, this backdrop is encouraging more attention to inflation protection and real assets, but the timing and sizing of those exposures remain highly sensitive to the evolving path of oil and policy. Bringing it all together, the cross-asset picture today is one of resilient growth and powerful AI-driven earnings running into the hard constraints of higher rates, potential energy shocks, and heavy capital raising. Equities are moving from a one-directional AI meld-up to a choppier regime where sector rotation, IPO supply, and valuation discipline matter more. Rates markets are leaning further into a higher-for-longer narrative, with inflation data and oil now critical swing variables, while credit still enjoys tight spreads and ample liquidity, even as private structures and energy-exposed sectors show more strain. The dollar's near-term resilience contrasts with longer-term valuation concerns, and commodities, led by oil, sit at the center of both the inflation and growth debate. For allocators, the key watch points are upcoming U.S. inflation releases, the trajectory of Middle East tensions and crude prices, the market's capacity to digest record equity and debt issuance, and how far tech and semiconductor volatility needs to go to reset positioning without breaking the broader earnings story. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.